Welcome back to the Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by Bull Realty Asset and Occupancy Solutions. Visit bullrealty.com. Today we're talking about the state of commercial real estate financing in the U.S. Please welcome my next guest. It's Edward Dittmer. Edward is VP, Head of CMBS Surveillance at Morningstar Credit Ratings, and he's joining us on the phone. Edward, thanks for being with us.
Thanks for having me, Michael.
Well, Edward, there's been a lot of news, a lot of stories about a lot of these big box retailers closing stores. What's that doing to CMBS?
Well, this is something that's going to probably cause a lot of headaches for CMBS investors and for borrowers over the next year or so. In the last month, we've seen, actually really even the last week, we've seen H.H. Gregg file for bankruptcy, Gander Mountain filed for bankruptcy, and just this morning Gordman's, which is a Midwestern department store chain, filed for bankruptcy. So once that happens, CMBS investors and borrowers have to look at whether or not that store is going to close and whether or not the company is going to reject the lease as part of the bankruptcy. Once that lease is rejected, then the tenant can stop paying, and the cash flow from that tenant stops pretty much immediately. And the borrower becomes an unsecured creditor of the bankruptcy estate. So one of the things we look at with some of these big anchor boxes is the difficulty in re-tenanting the space. And we've talked a lot about some of the malls that have gone through mass closures by stores, and we're finding that it's getting increasingly difficult to fill some of these anchor spaces. There's a lot of cost that goes into it. Sometimes you're not going to be able to find a tenant that wants a 40 or 50,000 square foot box, so you may have to put in the expense to break it up into smaller pieces.
Right. And Edward, is this a sign of things to continue? You wrote an article recently, More Clicks, Less Bricks. And so is that growth of online sales going to continue to create issues in a retail financing world?
We expect that it will here at Morningstar. When the internet first became a thing back in the mid and late 90s, you had the category killers that took out whole chains. First was books and electronics, but now we see the internet really hitting all sorts of retailers, and they're nibbling away at the margins. So if you look at apparel shoppers, well, somebody might not go and buy a dress shirt at an internet outlet. Some may. Every time that those internet retailers get a new category that they can go into, whether it's socks or neckties or belts, that's just a little bit more money that's out of the retailer's pocket. And in the case of sporting goods, we've seen this year a ton of sporting goods retailers have filed for bankruptcy and closed up. You can buy all of those things on the internet, and it's something that we see continuing going on for the next couple of years. And some of these retailers that are in business today might not be in business in another year or so.
So, Edward, what are the types of properties that are going to have the most impact from this situation?
Well, the property type that we continue to look at and highlight is regional malls. When the anchor boxes close in a lot of these B-quality regional malls, it's very, very difficult to get a tenant that wants to fill that space. The A-quality regional malls do very, very well, and they often have tenants on waiting lists lined up to take that space. But at the smaller malls, the ones that are in secondary and tertiary markets, it's really difficult to find somebody that wants large boxes that come vacant. And honestly, some of those malls are probably the ones that are going to default at a higher rate than a lot of the retail properties, than a lot of your anchored retail centers. The other issue with regional malls is that when they do default, the risk on those tends to be much higher in terms of loss severities. Of the 200 or so malls that have been liquidated out of CMBS over the past several years, most of those malls had a loss severity of over 50%, and a large number have loss severities of over 75%.
Wow. Well, Edward, are there some groups that are seeing this as a potential opportunity?
There are investors that have acquired some of the leases out of the bankruptcy courts when they're affordable enough. I think you may see some of that come up with some of these Kmarts and Sears that pay maybe $1, $2 per square foot. Some of the Sports Authority leases were acquired by investors out of bankruptcy, and they may find an opportunity to re-tenant that space. It's mainly in the centers that have the really, really strong demographics, those Class A centers, where somebody can acquire one of those leases fairly inexpensively, and then they can re-tenant that space for much, much more.
Right. Comes down to location, doesn't it?
It sure does.
So, Edward, what is your advice to a borrower who has retail properties where they might have some potential exposure to this issue?
Well, you really want to get out in front of it. If you know that your tenant has some problems coming down the road or is a candidate to possibly file for bankruptcy or close stores, you probably want to work to line up another tenant in the meantime, or at least get some interest in that space. If it's a space where maybe the center's a little bit tired, you may have to put a little bit of CapEx into it to make it more attractive to another retailer that might want to come in. If you are in that position where your anchor store's closed and filed for bankruptcy and the rent is going to go away, you want to get out in front and call your loan servicer, your bank, and start working with them right away. That's the best way to get ahead of this. Sometimes those banks may require you to put up a little bit of additional cash in order to save the property. That's where we do see some of the conflict and some of the loans that ultimately get foreclosed on, is that those borrowers just really aren't seeing the return if they invest additional cash. But that is often what you're going to have to do in those cases.
And most of these loans on these types of properties, Edward, there's no personal guarantees or corporate guarantees. Most of these are what, life insurance loans or CMBS loans?
Most of the ones we cover are CMBS loans, and CMBS loans, for the most part, are all non-recourse.
Right. So some of these properties, the developers, the owners may be saying, hey, we give up, right? Absolutely, and that's that I think is why CMBS loans have had a problem with this, is that if you've got some personal recourse left in the loan, then you might want to invest some additional cash to help preserve your investment. But if you really don't have anything on the line and you're being asked to put up $1 million, $2 million to secure a modification of the loan, it might not be worth it. Right. And I like your advice. Get out early and look at the situation and contact your servicers and maybe let them know you have potential imminent default coming up, and get ahead of it, because there might be some ways if you both have the problem, right? Absolutely. The servicers are there to preserve as much as they can for the bond investors that have bought the CMBS bonds. So their interest is not in taking the property back and selling it in a liquidation sale. Their interest is in trying to keep you involved in the property and keep you managing it, because that's not what their competency is in managing property. Right. It seems like we had a lot of this a few years ago, right? And we were doing some recapitalization, bringing in some investors to work with these existing owners to bring in the capital and to turn around these properties. Yeah, and there are opportunities. There are private equity investors that might be able to come in and help bail somebody out of a situation. You might have to give up some of your equity in the property, but it might preserve the investment going forward. Right, and if nothing else, you keep the management, you keep your name in good standing, you keep the leasing, and can work out for everyone. Well, Edward Dittmer, thanks for joining us. We appreciate your insight. Thanks very much, Michael. I appreciate it. Stay tuned. Right after a short break, we're going to talk about something else that's growing, and that's online mortgages. You might be surprised what you can do and how quickly you can look for loans. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.